Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. If you've been listening to this show for a while, you know we focus on going a mile deep instead of a mile wide. That's exactly why we're buying again in Tucson, our 12th deal in the market. Our latest acquisition, Icon on Broadway, is a 300-unit multifamily community purchased well below replacement costs with day one cash flow and conservative underwriting. We're projecting a 16 to 18% IRR with significant bonus depreciation in year one. If you're an accredited investor and want to learn more, you can access the deal room at breakofdaycapital.com.
Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes.
Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky. Today on the podcast, we have Brett Swarts returning. Brett is a real estate investment advisor, Amazon bestselling author, podcaster, Deferred Sales Trust trustee, and a California multifamily broker. He's the founder of the Capital Gains Tax Solutions and EXP Commercial Multifamily Broker. Each year, he equips hundreds of millionaires and business professionals with a Deferred Sales Trust tool to help solve capital gains tax deferral limitations. Welcome, Brett. Can you start by telling the listeners a little bit more about what you do?
Yes, thanks, Gary. Yeah, we build capital gains tax exit plans is a simple way to think about it. So if anyone's listening and they have a large exit of Bitcoin, business, real estate stock, especially AI stock, which we're talking about today, and SpaceX and different ones like that, we can defer taxes and we don't have to be trapped by, not selling because of the tax amount or move to Puerto Rico or try to move to a different state. You can actually really sell and then diversify the wealth in a meaningful way.
Obviously, it's a lot more comprehensive than a 1031. Let's talk about, because I think a lot of people know the basics of a 1031, but I don't hear a lot of people talking about a DST. Why don't you talk us through the basics?
Yeah, and so the basics are that you have certain tax laws, and I like to do whenever something's a little bit more confusing, the best way I've learned to figure things out to simplify it is to do a kind of like bridge. And a kind of like bridge is basically what is it kind of like that you already know. So you probably already know about an IRA or a 401k, right? They're places where you can place money in. If you do it in certain timing, in certain sequence, you can defer tax. And when do you pay tax? When you receive the payment. So think of this kind of like a big 401k or a big IRA that you're setting up right before you exit, because you have a large tax bill and you're not going to pay tax until you receive payment back over time. And so our particular tax code is called IRC 453. It's known as an installment sale. The difference is we combine that with a trust and a third-party trustee. And so Gary's selling a Manhattan Beach property that he's owned for very, very long, and it's worth $10 million as an example, and there's zero basis remaining. Well, if he were to sell that tomorrow at $10 million, he's going to pay state California, federal, probably at least 37 to 45% in tax with depreciation recapture. In our scenario, we're able to defer that by selling first to the trust and you taking back what's called a seller carryback note or a promissory note. And since you became a creditor, you change the nature of your ownership from owning the asset, the property, to owning the asset, the promissory note. And you haven't taken any money at closing. The tax is in a deferral state. The trust sells it immediately to the buyer for $10 million. The trust receives the cash and the trust has no gain because it bought and sold for the same price. You only pay taxes you receive payments back. We set an interest rate on the note, let's call it 7 to 10%, and you only pay taxes you receive payments. And this is the beauty of this thing. Now it can be diversified. There's no more timing restrictions on this investments, nor are there timing restrictions on what you can put it into or how or where you can put it. So that's kind of the basics.
Nice. And we mentioned SpaceX because, down where I am, geez, I probably run into 20 SpaceX people, and obviously it's going to create 400 millionaires. How does that work for former or current SpaceX employees?
Great question. And so we have a second version that works for public stock or private stock. our first version I was just speaking with is really real estate, business, private stock, Bitcoin. The second version, it works for public stock. So public stock's a little more restrictive on what you can do, but it's very similar. It's a payment plan with a third-party trustee. The trust, though, is an irrevocable trust that your children are the beneficiaries or can be the beneficiaries of. And you can sell it to this irrevocable trust in exchange for basically called a deferred payment plan. The reason it's different is that the interest payments are going to be partial interest, partial principal. So it's always a mix. You're going to pay cap gains as you get payments back, whereas the other one can be fully interest payments. And so, but really simple. We set up a new trust account. We open it up at, we typically use Charles Schwab, right? And then you would do like an in-kind like transfer, right? Or you would do basically an assignment of the stock to the trust, and then the trust would issue a promissory note. So let's say you had 100 million of SpaceX stock, right? Well, instead of selling it to the open market and having a huge gain and paying the tax, you're going to first assign and or sell to the trust in exchange for a deferred payment plan. The trust is going to sell it for 100 million in the open market for cash and receive the cash into the account. But because it bought and sold for the same price, Gary, the trust has no gain. Okay. And then the trust pays you back over time, and then you just pay tax as you receive it. Payments are based upon your life expectancy. And if you're married, your spouse life expectancy. And then the IRS has a certain interest rate that they set for that. However, you still have all the flexibility for the investing. It can go back into other investments of your own or with partners or syndications like what you do, Gary. A stock market, you can diversify. And I think that's really the focus here. Like most of our clients, they want truly passive income and the ability to have the entrepreneurial freedom. And the challenge with a lot of strategies is in order to get that freedom, you have to pay the tax. Our strategy gives that flexibility plus the freedom. Oh, by the way, we also eliminate the estate tax on that $100 million exit, which is a thing that gets overlooked quite a bit.
It's such a valuable option, and I don't hear people talking about it. I hear this obsession with 1031s, but really, and particularly how many uses you can use it, the deferred sales tax trust in so many different ways. So super, super powerful.
Yeah, I mean, it reminds me when I was at Marcus and Millichap, selling multifamily properties as a broker in Sacramento. And I had a mentor, Gary, and he said to me on the phone, I was having a tough time in my first year of cold calling. I was just, wondering if I'm calling the people like Gary, like how to get them to get a meeting with me, right? When I'm kind of the new buck in town. And he said a really key line to me. He says, Brett, the moment you know more about, the seller's problems or his property or properties in the area is the moment you start adding value. Everything else is wasting their time.
Yep.
And I was like, it hit me with a ton of bricks. And I was like, wow, you're right. I need to not only know their problem, but know their solution, plus know something that's going to give them an edge. And that's what we found with this strategy is it really does give the entrepreneur and the investor the edge. We believe in tax flow, cash flow, and debt flow is really the mindset that you should take. The mistake that most entrepreneurs and investors make is they only have a cash flow mindset. Now, granted, that is very, very important. It's probably the most important, but I think equally or pretty close to it is tax flow and debt flow. And if you can get all of these working in a way where time is your friend and you can leverage time to be your friend, then why not sell SpaceX at a high and buy multifamily in a marketplace, to be quite frank, is probably one of the best buying markets we've seen in 10 to 15 or 20 years, right? It's a great time to buy multifamily. It's a great time to sell SpaceX stock. We don't know how long this is going to last, or these other AI, Anthropic, right? OpenAI. And it's about a $3 trillion, type of IPO season that's happening right now. And so we just want to be able to give everyone out there the ability to not only add value for the client if they have clients they're serving, but be able to solve problems in a new and meaningful way.
Amen. And you have a ton of resources on your website, I assume, right? Is that the best way if people want to?
Absolutely. Yeah. We have our book called Building a Capital Gains Tax Exit Plan. And it's basically my journey of what I was referring to. We believe the next chapter of your life requires a new shift in trust. And you may have a team in place that maybe doesn't know how to do this. And we want to coach and train them and show them, in a sense, partner with them. We are the trustee, but we love training CPAs, financial advisors on how this works, estate planning attorneys. And building a team is really what we're talking about here, building a capital gains tax team, because it's state tax, capital gains tax. It's brutal. And the more team members you can have on the team, the better you're going to be positioned to take advantage of every tax law that's out there. So yeah, get the book, Building a Capital Gains Tax Exit Plan, and then go to our website, Capital Gains Tax Solutions, to schedule a one-on-one consultation call. You just have to qualify. It's just $1 million net proceeds, $1 million gain. So as long as you have a big enough transaction that qualifies, we're happy to sit down at no cost, no obligation to walk you through how this works, if it could be a good fit. Of course, we always promise never to talk you into something we don't think is a good fit. We'll let you know right away. We've done this for a while now. We're very, and you can kind of tell what's a good fit and what's not. So yeah, just go to capitalgainstaxsolutions.com.
Nice. And deferring taxes, I've used bonus depreciation, and it's really allowed me to rocket fuel my net worth. I mean, you look at when you run it out over 10 years and not having to pay taxes, just following the tax law, not doing everything legal, it really, really creates tremendous wealth.
Yeah, I'll add to that too. We like to look at income tax deferral opportunities as well. So let's say you had $100 million of stock, right? And you were able to do this transaction, and then you can partner with the trust into a new LLC, and let's say invest it into a multifamily property with Gary as an example. Well, I think you have that 300 units that you're working on right now. That's a good opportunity in Arizona. Well, now I can start to stack and layer different strategies that can offset my ordinary income tax if I can qualify as a real estate professional, or at least offset my passive income, right? And so this is you think about it like, wow, not only would they have paid, let's say 37% on a $100 million exit, or let's make it a $10 million exit, $3.7 million. But now they can partner with the trust to establish, has a new basis, tax deferred into a new asset, which is a fresh depreciation schedule, of which gets that bonus 100%. Then you start really getting tax flow in your favor, tax flow depreciation to offset ordinary income tax. That's huge, right? You can also let the trust delay for a couple of years before it pays you anything and let it compound. And that means you're deferring 100% of the capital gains tax, 100% of the income tax. And so you want to really look at layering and sequencing and combination. And that's the mindset you want to have, is what can I use in combination, and what team can help me execute it in combination? And how do I leverage multiple strategies when I'm already going to be investing in multifamily or in real estate? I might as well do it in a very tax efficient way.
So 1031s, there's a good percentage that get blown up. And can you, at that point, utilize a DST to help save you?
Absolutely. This is one of our, I think, best kept secrets that we're trying to get the word out, that, friends don't let friends do a 1031 exchange without a backup plan, right? And so one of the biggest challenges with the old guard in the real estate, and I say this with all due respect because I'm part of the old guard. I grew up building houses in the Bay Area of California, owning rentals with my family my whole life, and then at Marcus and Millichap doing lots of 1031s during the 2008 crash. And unfortunately, a lot of them don't want you to know about this. They don't want you to know that you can save a failed 1031, that you don't even have to do a 1031 if you use our strategy. But let's just say you are going for a 1031, or you're listening to this right now and you're like, wow, I don't want to get caught running out of time on my 45 day, and I don't want to get caught with the deals not working out. We can save a failing 1031 exchange without taking up one of your typically the three property rule. Keep in mind though, not every exchange company wants to cooperate or wants you to know about what we do. So you do need to be working with us and or transfer your exchange to one of our exchange accommodators, who's one of the best that we've ever seen and that are strategically aligned with us. But particularly the exchange agreement has the language to defease into our deferred sales trust. And so keep that in mind. If you're in a 1031, call me too, because we want to put you in the right position where if you do the 1031, great, high fives, you found it. But sometimes it could be a half and half. You might do a $25 million exchange and have a $5 million perfect property, but the other $20 million was going to go into our strategy, or vice versa. We don't want the tax tail to wag the investment dog. We want to give you leverage to be able to execute on the deals that you'd like to do. So yeah, we can do that. Just again, go to capitalgainstaxsolutions.com to get started on your 1031 as well.
And also, I think I read in your notes that partnerships are, I've certainly had my fair share of partnerships, and when partnerships are going bad, you're able to find a smooth dissolution to it. So talk us through that.
Absolutely. So sometimes partners are in different stages of life and they have different needs. They have different estate planning needs. And what might be going well for 5 or 10 years, life changes, right? There's death, divorce, dispute, disability. and things change, and there's nothing worse than feeling like you're stuck because your partner doesn't want to sell right now. Well, we can have one partner in that situation buy the other partner out, and we can still defer the tax. Now, in a 1031, you can't do that, right? In a 1031, the whole entity typically has to move all at once. And so let's say you want to buy a partner out, you can do that. Or the other scenario is you're selling the property, but one wants to go one way, the one wants to go the other. Well, depending on the ownership of the entity, and especially if it's a joint venture LLC, it's really pretty simple to separate the partnership into a trust, right? In exchange for a promissory note. Let's say both of you want to do it. Great, even better, because we can do 2 trusts for each of you, or 3 trusts, depending on how many partners there are. We've even done it with syndications like kind of similar, probably what you have, Gary, set up, where the 2 GPs do it for the GP shares. The other LPs just pay their tax, because a lot of syndications do not 1031 for a number of reasons, mostly because clients are ready for their capital back typically. And so that is a great way to do this. So again, works for businesses, real estate, partnerships. Each family unit could have their own trust that owes them the money. And when I say own trust, but let me also clarify, there's one where it's the family is the entity, or is the kids are the beneficiaries. The other one is actually a third party trust that just owes them the money. So you are selling to a third party unrelated trust that owes you the money, but that trust will only do business with you, and you're married, your spouse. And the other one would do it with the other partners. No, the partners don't have to all come together in one trust.
And for someone just learning about DSTs, is there something that I haven't asked that they should know about to help them?
Absolutely. We believe that truly passive income is to your freedom, is as compounding interest is to your money. We think it's the biggest thing that the 4th quadrant of the Robert Kiyosaki that we're all trying to get to, that most people never unlock. Either they haven't scaled large enough, or they have all the equities locked up in their primary home in Hermosa Beach, or it's locked up in that SpaceX stock, or that Bitcoin, or that that business or real estate, and they're looking for that truly passive income. And we define that as 30, 40, 50,000 plus more per month, and it's actually really passive. You're not having to trade any time or energy for it. And we call it the wealth quadrant illusion, right? And this is kind of for the entrepreneur, right? This kind of 2 ladders side by side. And one is what they think they're doing. They're first they're employed, then they're self-employed, then they're a business owner, then they become an investor, and they're kind of just laddering up slowly. But the reality is they're employed, they're self-employed, they're bigger self-employed, they're even bigger self-employed, and they look up and they go, gosh, where's all my time and my energy going? I thought at some point this thing was actually going to be passive, in quotation. So we call it truly passive. And so the exercise is to get truly clear on that number. What is that number for all of us? Is that, $30,000, $40,000, $50,000 a month or more? And what would happen if you could achieve that? What domino would fall over? And so I'm not telling you to quit your day job today or your business today, but I think it's important to keep that in mind, that we don't want to trade what's priceless for what's profitable, because something can be really, really profitable and really, really exciting. Now, if it's your calling in the season of life, stick with it, right? But if there's a way to unlock this truly passive income, man, don't wait. Don't wait. Life's too short. It's too short. We never know how many days we have left on this side of Earth. So I would encourage you to don't trade what's priceless for what's profitable.
Nice. Well, Brett, what a treat to have you on and really share your knowledge on DSTs. I know you mentioned your website again. Say it one more time so people can go to it.
Yeah, capitalgainstaxsolutions.com. You can also go to brettswarts.com, SWARTS, Brett with 2 T's, to follow all the social media and see what I'm doing on the other side of just business. But capitalgainstaxsolutions.com, if you have a live deal for yourself or for your clients, book a consultation call.
Nice. And check out that book, guys. So thank you so much, Brett, for coming on the show. If you like this episode, please head over to iTunes or Stitcher and subscribe, and review this podcast, as it will help us grow our audience and reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website, breakofdaycapital.com, and sign up for our newsletter. We will talk to you next week. Thank you. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.